Welcome all. Welcome to Financial Fitness Program. My name is Samir Bapat, and today we are going to learn about candlestick. We are going to understand the fight between bulls and bear. Before we begin, I would like to thank you all for your time. I know the offices have started. It's a busy schedule. Still, you chose to join the program. So grateful of you. Thank you so much for joining the webinar today. So let's begin. Now, how many of you have attended the previous Tuesday's webinar? Can I have yes from all of you who had attended the webinar in the last Tuesday or seen it on the YouTube? Attended? Yes, yes. Okay, you watched. Okay, great. If you have watched, if you have attended, great, fantastic. So let's take it to the next level. Let me tell you, what I'm going to share with you today is very, very powerful. If you understand, if you monitor, and if you start using it, automatically you will know the pulse of the market. So even if I have mentioned it, it's for exclusively for beginners. Don't take it lightly. Take it very seriously. Go through the webinar today on YouTube again and again, because if you understand what I'm sharing with you today, it's a very, very powerful thing which you will learn today. Okay, so can I have yes from all of you if you are ready to learn a very, very powerful technique? Yes? Okay, great. So let's begin. Now, what is the purpose? We have to earn money. Simple. उसमें कुछ बोलने की जरूरत नहीं है. So candlestick pattern. I'll just quickly take you with the review why we are learning candlestick pattern, because it's the language of the chart. This is how the stock market, the people are trading in the stock market. Whatever data they generate, that is getting imprinted in the charts in the form of charts, and we are learning the language of the chart. So that's why we are learning the candlestick. It was developed almost 300 years ago in Japan by Mr. Homa. He controlled the rice futures trading, derivatives trading, and he was one of the wealthiest person in Japan in those days. So Japanese candlestick pattern is like yin and yang, like I mentioned last week, and it's for same thing. You have equal and opposite thing. So that's why this is yin and yang, like plus and minus, male, female, like that, day and night. Now, as I had mentioned earlier, we have everyday market opens. As you're aware, 9:15 the market opens. The price dances throughout the day, and at 3:30 the market closes. We have typically four data of our interest: where it opened at 9:15, how high it went in the day, how low the price went in the day, and what was the closing price. So taking this four uh, prices in account, we are making the candlestick pattern. This is a candlestick pattern. Rectangle is drawn wherever is the open price from close price. Rectangle is drawn if the close price for that day, if the close price at 3:30 is higher than the opening price, 9:15 the price opened here, 3:30 the price closed here, a rectangle is drawn and it is shaded with green color. From there, however high the price went, a wick is drawn, and lower it went, a wick is drawn, since it looks like candle. Hence, the Western world called it candlestick patterns. I don't know whether Japanese called them candlestick or not, but definitely Western world got introduced to candlestick pattern in 1990s. Japanese are using for 300, 400 years. Western world and India and all this world got introduced to this technique from 1990s. So this is the rectangle is called body, upper wick, lower wick. Same yin and yang. So since we had a green candle, we should have a red candle. Opposite, equal and opposite. So here, if 9:15, the price opened here, closed at lower level by 3:30, then a rectangle is drawn, colored red, and this is called, so we'll know, okay, the price went down during the day. This is how it is represented, which you have seen in the last video also. Just wanted to do a recap before we dive into it, because few people might be new in the webinar. So this is the black and white era. White is it went up, black is it went down. Okay, so candlestick tells us the story of that fight. So every day bulls and bears are fighting. Every day they are fighting. From 9:15 till 3:30, they are fighting with each other, not literally with fish, but by placing the orders. And every candle tells the story of fight of that day. First, I'll take you through the each day's candle, then where to look for those candle and how to compare. So be ready with your notebooks and everything to note down what I'm going to share with you today. Can I have yes from all of you if you're ready to learn each and every candle? Because then you'll understand the language of the charts. You'll try to pick up, you'll learn to pick up very fast from the chart what is happening in the market. Yes? Okay, great. So let's move ahead. Now, this is called Mariposu candle, or this is standard bullish candle. Now, just to get the perspective, let me take you to the whiteboard. Uh, can you see my whiteboard? If yes, type W. If someone type W, if you're able to see my whiteboard. Okay, great. Thank you. Now, what I have done is for the dramatic purpose, let's assume, let's visualize that tug of war, rope pulling uh, competition is going on between bulls and bears. So on my right hand side on my whiteboard, you can see the bulls are at the top and bears are, the bear team is there at the bottom here. Bulls are here. There is a ball in the center. There is a rope which is held by bulls and bears. So everyone, you can imagine this situation that okay, in the morning 9:15 the games begin. The bulls are on that side, bears are on this side. There is a ball, there is a rope, and they are starting to play the game, play the fight, play the tug of war. Now, at 9:15, let's say the price opened here. Okay, some X rate, the price opened there, and the throughout the day from 9:15 till 3:30, the bulls kept on pulling the rope, pulling the rope, pulling the rope, and they took the price. At the end of the day, the markets kept going up. Of course, it will not go in a linear way, just to represent it in a some way to you. Let's assume they kept on going up. So if you have to convert this into candlestick, then we will take this opening price, we'll draw one line here at opening price, and we have a one candle here, and this is a candle. When you see this green candle, that means the price opened here and the bulls kept on taking it up, 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 up. That's why we have a green candle. When you see a green candle for a day and it is completely green, you are, that means that day bulls win the fight. Also, not only that, let's say the price started here, it went down, and then after some time bulls started taking it up, they took it up, 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 up. Sometime it went up, then by close the price came and closed here. This candle also is a normal candle. We'll say from open, we will draw one line here. From close, we will draw a line here. Since the close is greater than open, we are drawing a line. This is the high. From here till high, we'll draw one wick. From here to low, we will draw one wick. So this is a normal standard green candle. Here also, yes, the bulls did not start from the word go and took it high, but still, as the market opened, the bulls were winning all the time, and then they took the market up, 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 or whatever stock it is, they took it up and closed at a high. If it's crystal clear, can I have CC from all of you? If this picture is crystal clear, what I presented to you just now? CC? Okay. Now comes the important part. ठीक है, ये दिख रहा है. Let's go to some chart. Okay, so now here is I am going to share with you a very powerful thing. Now you see today in the morning, uh, the fight started between bulls and bears. They kept on taking up, 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 up from year to year. So this is a bullish candle. This is also a bullish candle. So here also bulls started pulling the market. They kept on taking it up, 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 up from here. This is also a bullish candle. The bull started taking it up from here to here. This is also a bullish candle. This is also a bullish candle. And this is also bullish candle. So everyone, when you see a full candle, green candle, you can imagine that bulls kept on pulling it up from morning till evening. Important point. Now you have to pay attention. I am zooming in, and this is very, very important. Pay 100%, 200% attention. Now, see, this is the candle. Okay, this is the 30th of August candle. This is the volume, the number of shares traded. This is the volume bar. Below is these are the skyscrapers, are the volume skyscrapers. This is the volume. This is the participation of bulls in this candle. So many volume was there, so bulls took it. Now, if you see here, this is also participation. Or if you want to see here, okay, it is better to compare with close to close. Here also is the volume, and this is the candle. This is also bullish candle. This is also bullish candle. Yes, so we have 30th August bullish candle and we have 24th August bullish candle. If we compare it with the volumes, which volume is higher? 24th volume is higher or 30th August volume is higher? You can see on picture right here. So just type 24 or 30th, whatever you understand. 24th, correct? Now you see there has to be, like we studied in the school, there has to be equal and opposite. For every action there is an equal and opposite reaction. Correct. We all studied something in, I think, before 10th. So here, in spite of so much volume, the price went from here to here. Chutku sa candle bana. From here to here with a low volume, it has gone up from here to here. Yes, we are happy. The HDFC Bank has gone up. From yesterday, it has gone up by 3%. But the important point I'm trying to make here is if you compare it with nearby candles, the participation is less. If the participation is relatively, you need not go 5 years back and what is, just see nearby. Okay, nearby. Okay, this volume, this candle was so huge from here to here. Volume is this much. If you see a green bullish candle here, this is the volume. If you see a green bullish candle, this much is the volume. For this much volume, if the price is moving only this much normally, and today it went so much, what I would interpret as the action, right? The reaction is not proportionate to the action. Okay. The volume is less, but the reaction is too much. If you hit someone like this and he starts crying, ah, like that, he starts crying, oh, hey, what? I hit only this much. So he's overreacting. So this we can say with reference to the adjacent candles where they have higher volume, but the width of the candle is low. This is something exaggerated reaction. So two things we have learned. One is what is a bullish candle, and second thing is we have to understand the bullish reaction with reference to volume. Even if the candle is very much long, but the volume is less, it's a overreaction. So we should be cautious. We should not be very happy, or we should immediately jump to buy. Wait for subsequent days and see how it turns out. Fine. Everyone understood, right? What I'm trying to say here. Can I have yes from all of you if you have understood what I'm trying to say? Don't get carried away. If the candle is bullish, compare it with volume, compare it relatively with the volumes adjacent. If the price movement is too much and the volumes relatively are lower, don't be happy and jump in to buy. It can be a fake movement also. You might get trapped. Interesting? Okay. So now let's move to the next point. We have same bulls, so we have bears also in the same way. Now, if we see the whiteboard, let's go to the whiteboard. Let's change the color. Let's make the color as red. Like I said, candlesticks is all about yin and yang. Same day, same thing. If the market started at 9:15, the price started, bear started pulling it down. They brought the market down, 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 and it closed 3:30 here. How the candle will appear is it will appear a red candle exactly like this. A red candle. If you see a red candle, that means the market started at high and it kept on going down and it closed low. So bears kept the market down today. Similarly, a normal bear candle would look something like that. Normally, it will open here, it will go up, then it will start coming down, down, it will go down, and it will come here and it will close. So what we have to do is the first is draw open, then close. This is the candle. Please don't mind my drawing. It may not be perfect, but this is a bearish candle. CC. So we saw a very bullish candle and now this is a very bearish. So this, the entire day, the bears were victorious. Now let's see some example. And the important point, whatever was the important point for the bullish candles has to be same for the bearish candle. Now, if you see here, the volume is so high. Volume for the bearish candle is so high, it's up to here. And the volume, this is a overreaction. This is some reaction, this is some reaction, this is overreaction. Whenever you see a overreaction, that the price went down so much, but if you see the volume as reference to the adjacent, if you find, if you feel, because it's a art, it's not, I cannot say okay how much this. How many of you are engineers here? Anyone engineers type E? I am also engineer. Okay, I am also engineer. Okay, so now this is specially for engineers. Don't think and suddenly their mind will start working. Okay, then their question will be ready in their mind that okay, how much more is this much and what is the ratio and what is the proportion and all. Forget that. It's a art. Okay, artist will do much better in stock market. If you are thinking and suddenly you have started programming in the backend that okay, I'll scan this, forget it. Start observing it first, then you do the coding to find it out. Fine. How many of engineers were starting to plan the coding and were thinking of asking me, okay, how much is too much or how less is too much? Can I have yes? Any engineer? Okay, no one. Great, thank you. So now you see. This is the reaction. So when the markets, this is a bearish candle, huge candle, yes, the price went down too much, but then check the volume. If the volumes are not supporting or not proportionate to the candles adjacent, then this may not be a very bearish, need not to exit, wait for the subsequent candles to give you some signal. If the volumes are high and the candle is bearish, then it's a signal. Okay, see here. Let me find one good example at the top. See this one. This candle is long. If I zoom in and if you see this candle here, this is a bearish candle. Volumes are high. This is greater than this, the adjacent. We should be worried that yes, stock might go down. But if the volumes are less, see here the volume is there, subsequently the same size volume, same size red candle, bearish candle is there, this is almost similar kind bearish candle, but the volumes are going down, there is a possibility that it will turn around. So we should not feel afraid. So what we have understood is what is a bearish candle, what is a bullish candle, and should we get excited immediately? Answer is no. We should wait for the confirmation of volumes as well, along with that, to be really worried and not to be really worried. CC, can I have crystal clear? If you're crystal clear, can I have CC from all of you? I want everyone to type in CC if you are clear. Okay, great. Thank you. Thank you for acknowledgement. Now, now we want to know when the market is turning around. If the stocks are going down, we would like to know when the market will stop going down and it will turn up. How many of you would like to know when the market is bottoming out and you would like to buy when it is about to turn up? Correct? Now, let's understand from fight of bulls and bears. Now, what has happened is when you see the first, let me take the green. Now, let's say the market opened at this place. Okay, this high price was high. Now, the price started going down, 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 down in the daytime. It came down. So, the bears were winning. Okay, let me make it into color. Hold on. Okay, now here the market opened here, the bears took charge, they started pulling the market down, 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 and it went down from here. Subsequently, sometime in the market time, the bulls started taking it up, 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 and by the time the market closed here. So if we have to draw the triangle, we have to draw the candlestick. This is the opening price. So we will draw one line here. This is the closing price. We will draw a line here, draw a rectangle here. Since the close is greater than open, we will draw here. There was no higher price. And we will draw from here till here the wick. How many of you can observe the body is small and the wick is longer? When you see this, that means the the body is small, the wick, and this is what happened in the day. The price went down, 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 and it started going up, and so bulls are starting to take the price up. Now this is called hammer. This candlestick pattern is called hammer. Very, very important. And this phenomena is very, very important. I will tell you how. And very, very important for you to understand. Every time it goes down, see here, you can see the chart from here to here. We are taking the chart from 23rd February 2022 to it's going down. Now, see, the wick here is smaller. The wick here is smaller compared to the body. Here it is smaller. This has become bigger. And now, as it is coming down, how many of you can observe that the wick size is increasing? It may not increase every day, but gradually, if you see, it has come down, down, down. The wick size has started increasing, and we have a hammer here. Can I have yes from all of you if you are able to observe this? This wick size is increasing here. Yes? What is happening here is the bears are pushing the price down, but the bulls are trying to take it up. So this hammer or the wicks, longer wicks are more important at the end of a down move. If the stock is going down, down, down for a few days, as the wick starts appearing and the volume increases, you can get ready that okay, the downfall is near. There is a possibility of price going up. See here, 3 days it came down, 1, 2, 3. Then we have a hammer, but you have to be again cautious. This volume is lower. It has to be a higher volume. Also, even the hammer has to have a higher volume. That means bulls are with higher participant, then it will go up. So you can see, if you see here, of course, it will not come every time. Now, when it is going down, when it jumped, you see a wick and it going up. Let me bring one more good example. Let's take this example of gain. See here, it went down, it went up, it went down, and then you start seeing the wick at the support level. We'll take the support level later. It has gone down again. This wick has come here, longer wick. I'm not happy with the volume. Let me find a good thing with the volume. Okay, I have one wonderful stock for you. This is also, it can be red or it can be green. See, you can see the price was falling, falling, falling. You see this hammer, but it's only at the beginning. When you see some 4 to 5, 6 days, it is coming down. And how many of you can see the hammer here, type H, though it is red color, still you can feel that yes, the bears took it down and then the bulls took it up, and there is a high volume also. This hammer with high volume is very, very important. If hammer with low volume, see here, the hammer is with low volume compared to the adjacent candles, but this hammer is having a high volume as compared to adjacent candles. Look for hammer which is having a higher volume than the adjacent candles. Here is where the market is telling you the bulls are taking over and they will try to push and it will start going up. Okay, let's take what you're saying, July 11th. Yes, this hammer, the volume is lower. See this volume and this volume. You can see though it is a hammer, but it's not that strong, higher volume hammer. Okay, so hammer also we should have a higher volume. Second is when you see the lower wicks of a bigger size, that means bulls are trying to buy and take it up. Very interesting thing I'll tell you. Just hold on. Now here, one more thing what you have to see is here. Can you see this five, 4 to 5 adjacent candles? Now you see predominantly the wicks are larger. The wicks at the bottom of these candles are bigger than on the top. That means the bulls every day they are pushing the market up. Whenever at the bottom of any trend, if you see the wicks getting longer, consistently longer, then it's time that the market will reverse. Here is where you can position your trading. You can buy, you can get ready, buy. If the volume is good, take on the trade. If not so great, then you can come out. If you find this interesting, type I. How many of you found this interesting and this information very, very interesting? Type I. Okay, great. Thank you. Now, the same has to be on the reverse. Like I said, yin and yang candlesticks are yin and yang, so plus and minus. If the wicks have to become longer on the downside at the end of a downtrend, so we have to wait for the wicks to become longer and longer at the end of the downtrend. When this is a downtrend and then we see longer and longer wicks, we get ready that okay, it is going to go up. Similarly, the reverse way is also true. If the stock is going up, 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 up and up, what do you start seeing from here? This is the dragonfly doji, where a small body at the bottom and a longer wick on the top. That means the bears are pushing the price down. They are pushing the price down. And how many of you can observe that as it started going up, the wicks here on the upper side started becoming longer on 5th of July. This is longer. This is so huge, right? 14 July is so huge. This is so huge. And ultimately, the bears started winning the battle and then they pushed the price down. They pushed the price down. Then the lower wick started becoming bigger and the price started going up and it helped. Interesting. So now if you want to know, okay, when the market is about to turn around, you start looking at the lower wicks. If you want to know when it is going to go down, you start looking at the upper wicks. If they are becoming bigger and become, if you have an inverted hammer, something like this, then the market is likely to become weak and it is going to go down. Of course, you have to compare with the relative volumes as well. Crystal clear? How many of you are very clear about what I explained? Can I have CC from all of you if you are very clear about this patterns? Clear, CC? Okay, great. Uh, that's it. So this is 4 types of candle. What is important? Fifth is normal candle. Normal. This is a normal doji candle where the body is higher wick is also there, lower wick is also there. Here, even bulls and bears are not very sure what to do about Zydus Life share. So it's a equilibrium. When you see the body in the center, it's an equilibrium. Both bulls and bears are not very sure what to do about this share. So you will have to wait for a clear signal in coming days for taking a position. Third thing is, if you have to see whether the stock is likely to go down and the stock is likely to go up, you have to see consecutive volumes. Now, let's say here. Okay, let me take a better example. Okay, so I'll take this question. Can we say hammer means thing to buy and invest, hammer, inverted hammer, thing to sell after analyzing? It's time to get ready. You can say, okay, this market has told, okay, this is likely to go up. Don't jump in and buy that. You have to wait for the subsequent candles. Also, it is one that has to hammer and inverted hammer should be of high volumes. Second is don't jump the gun and start buying. You have to wait how uh, the next candle also has to support the hammer. It can be a trap also, because you have to always combine the candlestick pattern with the volume. If you are not combining, it can be a trap. It can be a trap created by the bears for you. They can as well stay away from the competition. You see a hammer, you jump in. Don't do that. It has to conform with the volume also. Now, what I'm trying to say here is, see, this is a red candle. The price is falling. See, this is the volume here, bottom on 18th of August. This is the volume. 19th of August, huge fall in the price. But if you see the volume, the participation is less. The price went down, but the participation is less. On 22nd, again a huge candle. So if you see only candle, it's a huge bearish candle, but the volume is again very less. That means if the price is falling, it's overreacting. If the volumes are also falling, it's not a serious fall. You should get ready for it to go up. Just observe for a few days. See every volume, if it is doing, even if you have a longer wick, you see, Shubh, what I was telling. See, this is the inverted hammer here, correct? But the volumes are very less. The participation is not there. This is a trap. This is a trap. This is a trap, because you will see the wicks are longer. The wicks are longer. Don't get into the trade. This wicks has to come at the end of the uptrend, not at the down of the uptrend. These are all traps where you start selling. So see volume. If volume is low, just don't do anything. Observe for a few days and then enter. Similar to something like this. See here you have it went down, so it has to go down. The wick starts getting longer. You have some volumes are increasing here, and it's increasing, and then it reacts and then it goes. So anytime you see hammer or inverted hammer with low volume, you have to wait for some days and then take some action. So with that, we come to the end of the session. I have shared with you five candles, I think 4 or 5 candles. So how many of you liked the session very much? How many of you have learned a lot? Can I have yes from all of you if you have learned a lot today? And you will be able, you, and I want one promise, that you go back and you start looking at the charts. You look at the candlestick charts with the volume and start making some informed decision. Just don't go by the price action. Price action can be trapped sometime, and you don't get trapped, so you are able to invest properly and with confidence. And if it goes wrong, just come out. Nothing wrong in saying, okay, I went wrong, and come out. So if you have any questions, let me know. Type in your name in the chat box. If you want, if you have any question, I'll come to you. I'll allow you to unmute. If you have any question, type your name. I'll come to you. Oh, no. Okay, great. No questions. Okay, great. So with that, we come to the end of the session today. I hope you enjoyed, you learned a lot of things. You'll have much more clarity on the price action, and you'll be able to take the informed decision and not get trapped in the price action only. Great. Thank you so much. Thank you for joining today. Uh, Next Tuesday is no webinar. Next Tuesday will be a we will build upon this, and we'll have candlestick reversal patterns. which will tell you when to buy more accurately. Thank you so much for joining. See you on next Tuesday. Thank you.